Hey, what's up, everybody? Welcome back to Investing Sucks. So in this video, we're going to be looking at Salesforce. This is a company that I've been meaning to do a deep dive on for a pretty long time now, and I've finally gotten around to doing it. So what we're going to do in this video is we're going to take a look at the Salesforce business and do a deep dive on it, actually try and understand the true value of what they provide rather than just looking at how they make money, and also discuss valuation because Salesforce is a company that has come down a lot in the recent months, kind of as that general pullback, as a lot of technology companies have lost a lot of value over the past few months. So we're going to be looking at their valuation at its current levels related to how much cash flow the business is generating to see whether or not it is overvalued or undervalued. So without further ado, let's actually jump into the video and let's start with looking at some basic valuation metrics for Salesforce. So because Salesforce is a technology company and a much older technology company that is actually cash flow positive, we want to look at a metric which values them at their enterprise value to their unlevered free cash flow, because unlevered free cash flow is a good indicator of how you actually get compensated as a shareholder of this business, because that influences the cash that they generate to make other acquisitions or invest in new businesses, like or invest back in themselves through R&D and really grow the business in general. So if we're looking at how they're priced historically on this metric, it's currently pretty low at about 23x. And typically it's been higher than that. It's been much higher than that actually in the more recent years, even as high as 40 in August of 2020. But if we extend this back even further, again, we can see it's still pretty much at an all-time low. Or I guess the all-time low would be right here in March of 2020. But historically, Salesforce is a company that has been pretty richly valued because a 40x multiple that does have a lot of growth implied in that. And we can see it was 40x in this area here and even much higher if we go back into 2011. So clearly investors are valuing Salesforce rather aggressively, but that has changed. And right now it's much lower at only about 23x multiple. So let's actually go over what Salesforce does. So what's the true value that they provide to businesses? So they are many things really, and they have many different businesses, but the biggest thing that they do is their CRM system, which stands for Customer Relationship Management, which they sell to other businesses of varying sizes, very large businesses and even smaller businesses at cheaper prices. Now, the businesses that they sell to, these businesses also have customers, and they contact those customers in various ways. So the issue before Salesforce came along was that different departments within a company had no centralized location to go to get the information to store all the different interactions that they have with their customers. It was very disorganized and it caused companies many headaches, and they would eventually lose customers because they couldn't really track how they interacted with all those customers effectively. So by the way, when I say interactions, I mean anything really, whether it's a sale that was made to a customer, an email that was sent out as marketing, a sales meeting that took place, if it's a larger company that's negotiating larger contracts, whatever it is, it's all tracked by Salesforce. And different people from different departments within a company, whether it was the sales team, marketing team, IT, they wanted to have a place to see all those interactions take place because it led to, well, it creates many different advantages, such as, being able to send customers more tailored marketing material, being able to resolve customer issues at a faster pace, and also allowing employees from different departments to collaborate more easily because they can see all this information stored in one place. And the platform is also very easy to use. That's a big thing when it comes to investing in software companies, is really for them to become extremely commercially successful. They need to have a platform that, solves a viable problem and is easy to use, because then if it's easy to use, a lot of companies can use it and it's not too much of a hassle to get employees and train them on how to use it. So the real beauty of Salesforce's business model is that there's really no limit on what industries their software applies to. It applies to governments, applies to retail companies, larger companies that are negotiating larger contracts, say like a construction company, and it applies to all those industries, and they can all use it in different ways. And over the years, Salesforce has developed many different solutions to actually apply to those businesses. Salesforce is also currently the market leader for CRM systems. We can see here just under 20% market share, whereas no other company even has more than 6%. We can see Oracle, SAP, Adobe, all other very large technology companies with vast resources that are able to invest in this. So it's not like they have no competition, because certainly competition from Microsoft, Adobe would definitely be considered formidable. And as we'll see later, there are different businesses that Salesforce is in that intersect with Microsoft in different ways. So I'll get into that. But as it stands now, currently you can see the market favors Salesforce. They are without a doubt the #1 CRM system. So that's a pretty big boost for Salesforce. That's definitely something to keep in mind, because this is a very wide lead they have. I think this chart here is a little misleading. I don't think they should be this much higher, but you can see clearly at just under 20% when no other company's at, or the highest one would be 5.3%. That's very strong and definitely something to take into consideration. So Salesforce is much more than just a CRM system. Although the CRM system is a huge part of what they do have many other businesses. So for one, they recently bought Slack, which is included in this platform and other section, which you can see 51% revenue growth year over year. That is quite strong. They bought Slack. It was a public company for $27 billion, which is a huge acquisition. So clearly they must see something there, because buying a fast growing technology company, when you are a fast growing technology company, you must clearly see some connections there and ways that you can benefit each other. Personally, what I think Salesforce is trying to do is buy companies that are similar to what they do and have similar aspirations, where they're trying to create a one-stop shop for companies to connect with their customers. And clearly they see Slack as a company that enables them to do that, which, for those who don't know what Slack is, they are kind of a messaging platform for employees at a company to use. So it's pretty similar to Microsoft Teams. I would say they compete with Microsoft Teams, and honestly, Slack is probably better than Microsoft Teams, but because Microsoft Teams comes packaged with all the other Microsoft products, more companies, I would assume, would use Microsoft Teams. The other business they acquired recently was Tableau, which would be this one here. So this is in their data section. So this is, relatively speaking, their smallest one, 20% year over year growth, which is pretty small. And again, Tableau is a company that competes with Microsoft, because Microsoft has Power BI, which is very similar to Tableau. They're both data visualization tools. So you can have different applications that feed data into them, and then you can build dashboards and use them for company presentations and that type of stuff. So I do think that the data aspect is definitely going to grow, because companies need tools to help them visualize their data. And having used Tableau myself, it is quite good. I've also used Power BI, and personally, I think they're quite similar in what they actually do. So they do definitely compete with Microsoft in that sense. So for Salesforce, acquisitions are clearly a big part of their strategy. Like I said, what I think they're trying to do is create a one-stop shop for companies to connect with their customers in various ways. So they want to find platforms that enable them to do that and enable them to be more digital companies, and visualize their data in different ways. And we can see currently they're generating, I can see 4.8 billion in cash flow from operations, 6 billion for cash flow from operations in the most recent year. And even more than what they're generating is going into cash acquisitions. So these would be the most recent acquisitions that they made. So clearly there's a big cash outflow when you're looking at the investing activities section. They do have a little bit of capital expenditure, but for a company like Salesforce, they are a software as a service business. So they're pretty much entirely digital. So this capital expenditure is always going to be extremely low, and it's not going to grow at the same rate that cash flow from operations grows. And what you'll also see is net income being very different from cash flow from operations. We can see here 1.4 billion net income, but 6 billion in cash from operations. So why is that? Well, if we kind of look at what reconciles the two, a big one is you have to add back depreciation, amortization. They are doing a lot of R&D spending, which R&D spending can get amortized depending on what the accounting rules are. And also, they compensate their employees a lot with stock options. And when you do that, you have to record that as an expense, which is, an interesting accounting rule, because if you think about it, giving stock options to your employees, you're basically compensating them with the future earnings of the business, right? Because you're giving them shares, you're giving them access to the future earnings and the future cash flow that the business generates. And those shares have value now. So the companies are getting compensated with that rather than just an expense, which would be if you're paying them a regular salary. So they have to keep doing that because they are a technology company. That's how you retain high-level employees, because technology employees are very in demand right now because a lot of companies are trying to go digital. For example, if we were to look at the income statement, and this kind of ties into a big risk that I personally see with Salesforce, because as we've kind of already established, they are a strong business. I still want to get into kind of the economic moat aspect of it, but we do know they're a strong business. But if we go down and look at the shares outstanding, so this is weighted average diluted shares and weighted average basic shares. So it's growing every year, 4%, 4%, 5%, 10%. Their share count just keeps going up. And I'd assume a big part of this is because they're issuing stock compensation to their employees. So they're basically taking away if you're a shareholder of Salesforce, they're taking away your ownership share of this business and giving some of it to their employees because they have to in order to retain them. So this is something that I think is going to continue as the business grows, they grow their employee base. They are going to have to continue to do this because it's part of their compensation plan. So I don't really think it makes sense to assume that if you're building, say, a valuation model of Salesforce, you have to assume that there's going to be further dilution because that's just the reality of the business. Okay, so now let's get into the economic moat aspect of Salesforce. So what I have on screen right now is estimates of future digital transformation spending. So I'll talk about later about what that is. But as we've already established in this video, Salesforce currently dominates the CRM market, but they don't dominate the company messaging market or the data analytics market and a few other smaller markets that they're in because they're competing with companies like Microsoft in those areas. So their economic moat is really just at present time, it's really just their CRM system. Okay, that's what I wanted to establish first because it's a system that companies are becoming increasingly reliant on. They need it in order to connect with their customers. And when a company uses a platform like Salesforce for such an important task, it's very difficult for them to switch to something else. It's very costly for them to do that because you have to retrain all your employees. You have to connect the new system to all your company's other apps. That takes away productivity, that takes away company resources, and it's a pretty costly process that can take a while. So unless another company comes around with a far better option than what Salesforce offers right now, which seems unlikely because, again, Salesforce has a ton of features, it's easy to use, and companies are clearly switching to it, as we saw from the market share that they have. So now that companies rely on the CRM system, they can integrate other businesses like Slack that they purchased, like Tableau, like MuleSoft, which is another huge acquisition they just made. So the CRM system is really just the foot in the door for them. Once they have the companies kind of locked into a longer term contract and they need the CRM system, it's easy for them to package and integrate other applications, again, to further this goal of creating a one-stop shop way for companies to connect with their customers. That's really the goal of Salesforce, right? That's what you're investing in. They are going to continue to use their cash to make these types of acquisitions and probably not pay a dividend for a while because that's what they see the value in combining businesses. Now, I also wanted to mention, and this goes back to the data that I have on screen here, why this moat doesn't just exist, but it's actually going to get stronger in the next few years. So to start, a question that I always want to ask myself before I make an investment in a company is, what needs to happen for this company to become extremely successful? I think that's a pretty standard question, right? You need to understand what needs to go right for this company for your investment to work out and play out, either how you see it playing out or even better than what your expectations are. And in my opinion, the answer to this for Salesforce is corporations need to allocate more of their budgets to, like I said, CRM systems, data analytics, and just digital transformation spending in general, which, as we can see on screen here, it's projected to increase quite a lot because the amount of data that companies collect on their customers and just on their supply chain, various things, it's forever increasing, right? It's increased at a very substantial rate over the past few years. And they need systems that are easy to use, that don't take a lot of time to train their employees on, that can allow them to make use of this data. And so as we can see on screen here, spending of this type of nature is expected to hit close to $3 trillion by 2025. And this is mainly driven by, one, the lockdowns that have occurred over the past few years, which forced businesses to become digital, but also businesses need to anticipate market trends faster because they need to respond to competition. They need to understand what customers want from them. And a CRM system is what allows you to do that. So when corporate budgets are becoming increasingly allocated to IT systems that enable companies to do this kind of decision making, and like I said, connect with their customers, This is the exact type of stuff that Salesforce offers. So to me, this shows that Salesforce is a company that is very well positioned to benefit from the direction that the business world is heading in. Okay, so the next thing I want to do is actually do a DCF valuation of Salesforce, again, to tie in their current price to what value the company provides in terms of the cash flow that it could generate now and well into the future. Because as we've already established, Salesforce has a pretty strong competitive moat. So I think it makes sense to assume that sales are going to continue to grow fast in the future. And with a company like Salesforce, really the key catalyst to their stock price, as we'll see in the financials here, is their sales. So as we can see in the past few years, their sales have been growing double digits. So you can see 33% here, and then growth has tapered off a little bit in more recent years, has been around 25%. Now, their gross margins have stayed pretty consistent, kind of 76, 74% range. They are a software as a service business, so gross margins are expected to be high, but their operating margins are quite low. You can see only 2% here. The highest it was 4.3% in 2018. So the reason why this is because they're increasing their R&D spending. As we can see here, their R&D spending is growing at an absolute rate, but also if you look at it as a percentage of their revenue, that's growing even faster. Now, they do have to make this R&D spending because they have to remain competitive in this market, and they have to continue to come up with new services to provide their clients, such as new data analytics tools, different artificial intelligence tools to integrate within the CRM platform. This is an expense that they have to make. But what this currently tells me is that Salesforce is a company that is not currently optimizing their business for profits. They are choosing to take a lot of the cash that they make and put it into R&D spending. And by the way, a lot of this R&D spending is actually just getting allocated to employee stock options. So that is going to actually, hurt the value of the business a bit in the future, because they are going to have to issue shares to those employees to retain them, which we've already discussed. So when we do a model, we are going to have to take that into consideration. Okay, so here is a super basic discounted cash flow model I did for Salesforce, and it uses what I think are pretty conservative assumptions. So normally I'll use a DCF model that looks something more like this, where we calculate the free cash flow to the firm and then get into what the enterprise value is. But I wanted to keep things a bit more simple with Salesforce, just because there were a lot of accounting gimmicks, as we've already discussed, that kind of made performing this more detailed and in-depth analysis a lot more difficult and subject to more error. So I wanted to keep things simple and just look at free cash flow as it's most commonly defined, which is CFO, or cash flow from operations, minus capital expenditures. So I assume that cash flow from operations will grow at 20% each year for the next 3 years, 15% for the 3 years after that, and then 10% for the 4 years following that. So this is a 10-year analysis. I do think that this makes sense. Again, it is a company with a moat, and companies with a moat tend to have long-term double-digit growth rates. Personally, I think this might even be more on the conservative side, but we can just leave it in for now. CapEx, because they are a software business, CapEx is probably not going to grow that much. So I really just went off of what it has been historically, so around $725, $750 million a year. So that gives us our free cash flow. I then discount this at a 10% discount rate to get the present value of the cash flow for this 10-year period. And then in terms of the terminal value, I took the 2031 cash flow and then multiplied it by a multiple of 30. So these multiples are just going to depend on the perceived growth rates that Salesforce will have after 2031. So a 30x multiple still assumes there's going to be some stronger rates of growth into the future for this type of business, which again, to me, that seems reasonable, because it is a company that is well positioned to benefit from a trend that the world is going to take, the business world is going to take for many years into the future. And then then we sum these two up, we get about $302 billion. And then we divide that by our projected shares outstanding. So this is where the share dilution comes in. So I assumed 3% annual dilution, which is low compared to what it's been historically. So I do think this is a more optimistic assumption, but this gives us a fair value per share of $235, and the current price is just under $198. So in terms of an annual return, it's just under a 12% estimated annual return if you were to buy Salesforce at its current price today and hold it for about 10 years. Now, obviously, that's going to change depending on our assumptions. So say annual dilution isn't 3%, it's 5%, which is more in line with what it has been in the past few years. That cuts your annual return down because you now own less of the business. You have less access to these cash flows that we're projecting them to generate. So that's something you have to consider. But overall, if we're looking at, say, a 12% return, that would be historically market beating, right? But keep in mind, that does require them to achieve $21 billion in free cash flow by the year 2031. So right here, $21 billion in, well, cash flow from operations. And in the most recent year, they did $6 billion of cash flow from operations off of $26.5 billion in free cash flow. So that's about a 22.6% margin. So we can assume there's going to be some economies of scale as they scale up their revenue and, you know, their cost per unit goes down. For example, their general and administrative expenses aren't going to be as large a percent of their revenue as the revenue grows at a faster rate. So say there's a 30% free cash flow margin. So it goes up from 22.6 to 30%, a little aggressive there, but let's just use it for our analysis. This requires them to generate $70 billion revenue by 2031, which to me doesn't seem that far off. I mean, they're currently at 26 billion in revenue, so we're saying 70 billion by 2031. But if we look at the growth rates that they've had, to me, it definitely seems reasonable. And as we've discussed, there's many great qualities about this business that make me personally think that them achieving that is definitely within the realm of possibilities. They are still the market leader. But the underlying assumption is that they're going to stay the market leader for the long term, you know, not just into 2031, but a 30x multiple after 2031 assumes that they're still the market leader at that point, right? So this needs to be a company that not just maintains their market leadership, but really continues to dominate the competition and continue to grow the business at a high rate, which again, it could happen, but it is a rather aggressive assumption. Okay, so let's now conclude what we've talked about. So I definitely think that Salesforce is an intriguing business at its current levels. As you can see on my assumptions that I had in the model, some of them were aggressive, but some of them were conservative. I do think that the business will continue to grow at a high rate, just based on all the great qualities we talked about. So I definitely think that buying into the valuation now could make for a good investment if you are willing to accept more risk, because this is a technology company. It's going to fluctuate probably more than the broader market. And especially with the way the market's been the past few weeks, there's likely to be a lot of ups and downs in this company. But if you are willing to stomach that, I do think that you can do well on this company, which again, that's just my personal opinion. But anyways, guys, I hope you did enjoy this video and you did find it useful. If you did enjoy it, then please leave a like and subscribe if you are new to the channel and you like this type of content. And I'll see you in the next video.